In trading and investing, there's often a saying, buy the rumor and sell the fact. And we could be seeing that this earnings season throughout most of the big tech stocks when they're reporting. Microsoft did well, driven by AI, but still dropped in after hours trade. And Alphabet's great earnings couldn't quite live up to expectations when it comes to the advertising section. But really, it was AMD as well that was showing us that it is a buy the rumor, sell the fact so far in big tech earnings, with the revenue forecast looking pretty good, but still the stock selling almost 6% after hours. So has this happened before? Well, as we shared in our previous video, we talked about tech earnings plus the FOMC being a critical juncture for stocks over the last two periods. And of course, this leads us into questioning what other instruments are we seeing with similar results. Today, we'll be talking about the big sell in the NASDAQ that took us down to the huge demand level, what happens if markets break through this zone, and whether this should be considered a good period to be buying these dips on several stocks that have had massive rallies recently since October of 23. There's a lot to discuss, so let's go through stocks, commodities, and cryptos together right now. Well, welcome back everyone to The Daily Show, where we talk about the macro, the lead indicators, and of course the hottest charts that all of us need to be watching right now. It was a rotation out of semiconductors where we saw warning signs on the horizon over our weekend video, and a rotation into financials and energy stocks. But it was really more of a potential buy the rumor, sell the fact through big tech that we already talked about in the previous video. Yes, we've seen it two times before, a tech earnings plus FOMC event that led to a sell and then a rally afterwards. Now, I've done a little bit more research into this, and you'll end up finding out that there's a 20% gain in both of these runs in terms of percentage. And we're right there right now with some interesting data that we'll look at in the video ahead in terms of some similarities to this, especially the July sell. Let's now go through what good signs and bad signs there are for the market. First up, we're already looking at 6 rate cuts this year. We have kind of gone between 6 and 7 rate cuts, and it looks like the Fed might be in trouble from a few things. Remember, they never rate cut out of the goodness of their hearts. They do so because they break something. So when they break something, what have they got to do? Well, they've got to come in and stimulate the economy. And we see core PCE inflation already underneath the Fed's targets. So that's really showing us that we could be in kind of a hard deflationary period, which means the Fed may be forced to cut earlier. And the market's already been preempting this with, of course, March expectations of where we'll see a rate cut. Will we get one in this FOMC? It's unlikely, but you can only imagine how the markets would react. I doubt that's priced in right now. Now, I want to talk about the idea of buying the rumor and selling the fact, because of course, in this case, everybody's actually in one type of investment. You've probably seen it if you've been following along on financials for a while. Japanese equities. Everybody's been on that bandwagon recently. And while the US equities have done incredibly well and it's been a great place to be, Japanese equities have garnered a lot of big institutional flow. Now private clients are purchasing it according to Bank of America in a big way. Is this a great time for it? Probably not if you think about it, because everybody's on that bandwagon. Also, emerging market debt and REITs. And if you know anything about our discussion on home builders, we've seen that REITs have been purchased quite heavily, or at least home builders, over the last 3 to 4 months, giving superior returns even to the market itself. What hasn't been purchased, though, is dividend stocks and obviously tips as well, materials, and a few things that have come up recently in the last week or so. So what else have we been seeing with big inflows? Well, we're going to do a special soon, so make sure to subscribe to Emerging Markets. And one of the reasons is we've just seen the largest weekly inflows into emerging markets ever, according to Bank of America. That's a pretty big deal, and there's certainly a large transactions going through. But what about another big high, a 10-year high actually, in terms of what we just saw with the skew? Remember we mentioned before the idea that July last year was a period where we had earnings, and of course we also had the big FOMC event. Well, it also turned out during that time we saw a huge imbalance between the overall call skews in comparison to the put skews. And you can see we've got a very similar thing going on right now with a massive call skew to a new high, a new 10-year high, showing us that there could be something that could unwind very quickly. And I think a lot of this is going to have to do with options ultimately, in terms of if we do go into some kind of flash event. And while the markets are still bullish, and we'll talk about that later on with the key level that actually was reached after the earnings events, we do need to be on the lookout for one of these kinds of problems, because you can see here that puts are at their cheapest that they've been in a very long time, according to Goldman Sachs. And that means that people are just not really pricing in any risk. And if people are starting to become complacent, that's the time when you've got to really start to question whether you're going to trade at these levels with nice tight stop losses and good kind of risk management, or whether you're going to say, okay, it's a great time for me to buy on a 10-year horizon. And I think it's probably not the best on the 10-year when you think about pricing route valuations on a lot of the stocks. Now, some are a lot better. Now, which ones are the worrying ones? Well, of course, it has to do with the biggest ones, the really top 10 to top 7, the Mag 7 to the top 10 stocks. According to JP Morgan, we're getting into that really high weighting territory where you've got to start saying, well, can these companies really hold up? If you've been watching the channel for a while, you'll know that my favorite stock's Microsoft. Do I think Microsoft's cheap right now? No. Do I think it's still a good stock? Absolutely. And do I think it'll be higher than it is right now in a few years' time? Yeah, of course I do. I think it's one of the earliest benefactors of AI technology as it stands right now. But this is another sign that we're going to be looking for in markets, and that has got to do with CTAs. Now, we've already mentioned the idea that if CTAs start to reduce, then we may be seeing a topping in the market. And we already know they're totally off the scale. We've shared this about a week ago and we continue to do so. But I've got another update here. Here's taking an interesting number from basically Goldman Sachs. And you can see that Goldman Sachs are still showing that on their CTA kind of spreadsheets, they're seeing still a high investment. And of course, the huge balance back up into the top. We're looking for this to start to show declines along with price action. And we'll talk about the price action later on, because if it breaks to swing level shorts, then we're probably talking mean reversion, and we'll go through that soon. Speaking of CTAs, we've also got some updates here for Brent, because of course, one of the big reasons why we saw so much selling in oil recently was that CTAs just dumped it, and it was really a buy the rumor, sell the fact. You can see the rumor, and then you can see the fact. And this was all to do with, of course, the conflicts that are going on right now. We've recently seen oil pick up, though. And of course, 78 a barrel was where we expected it to go to. And a breach of this level could expose a new uptick in CTAs that could also, in turn, squeeze the markets. And I'll explain why with options. Take a look at this 71 area in particular when it comes to a barrel, 70 to 71. Now, we talk about 68 being a price action level, and I still think it's key. But there's going to be a huge flip here in terms of options if oil chooses to break through this zone. And this area here could really expose quite a decent squeeze that could occur onto oil. So certainly one to be watching on the horizon over the next couple of weeks. And we've already been talking about it a lot with some pretty decent success from the price action standpoint. Let's talk about positive January. Is it a good thing? Before we panic, before we say, oh, look at that sell, it's nothing really in the scheme of how much it's gone up so far. Should we be looking at buying or selling when we talk about dips? Well, in general, positive Januaries, which we've seen, ends up leading into a pretty good year. And this is from Carson Research. And you can see here that there's some pretty good stuff going on now. We also know that if we're going to see volatility, Feb does tend to be the month based on statistics, based on the market itself. And interestingly, with election years, there's a lot to go through. If we have a sitting president running, we tend to see February also decline into March. So this is the kind of scenario that I guess we find ourselves right now sitting in. Of course, everything could happen this year. And I would say that while we're already seeing hedges for September and October into the November elections, there's going to be a ton of volatility that comes through in the first quarter, and I would think the third quarter of this year. April being a defining moment, though, for the mid-year. And join us as we go through the stats that are really going to surprise you for April, which is only in a few months now. S&P 500 performance, how does it perform from, generally speaking, kind of the back end of January to Feb 15th? Look, if you're looking at the stats, it does tend to be more of a positive period in time. Obviously, you'll notice that this study ends on Feb 15th. Why? Because that's usually where you start to get that negativity coming in on the markets. And to stop a freight train, which is the type of market we're in right now, remember it does sometimes take a fair bit of coiling and sometimes a Wyckoff distribution before it can sell off. And we'll go through that with our price action. Now, a bull is also going to light this year. It's an election year. We've got a 35-2 track record in similar times where we saw a November to mid-January kind of run up. And that's a pretty strong stat. And of course, when you're talking about really strong stats such as this and everything else we've been talking about, you do have to favor the optimism side of things with AI and everything else coming in. Now, don't expect more companies not to be laying off people. It's going to be a huge thing. I woke up this morning here in Australia and I had text alerts everywhere saying this company's laying off, PayPal's laying off, everyone's laying off. And this is kind of what the Fed has engineered. And now they've got to play the delicate game of trying to get the jobs in balance as we see more and more companies selling off, or not really selling off, but getting rid of their employees, and therefore probably becoming relatively more profitable as they're given reasons to be able to sack, let's say, excess employees they don't need. Now, here's an interesting one because it's got to do with kind of a narrative. And obviously, if you know the narrative on China, you would know the narrative is terrible right now. It's actually horrendous with Evergrande finally going bankrupt and basically being let to, I think there was like a video where they were demolishing buildings and exploding them all. And it's all pretty wild over there. Now, I bring this up because, of course, we saw the tech bust back in 2000, 2002. And then when we saw WorldCom filing for a Chapter 11, we actually saw at that period markets start to bottom off. And we've kind of been talking about this recently with the capitulation we saw on the Hang Seng Index recently, leading in, it was about a week and a half ago now, leading into a period where you often do see weakness. And then you start to see strength. In fact, 6 months and 12 months later, the market was pretty favorable in the bullish side. So when you're getting these types of lows in markets, you do want to be thinking about it. Now let's move over to Tesla, because this is the one that a lot of people have been messaging us about and obviously been discussing it on the internet. Will it recover from its brutal sell-off? Well, it has to, really, because every other time it's done a 5% or more gap down sell-off off a 6-month low, it's recovered over the next 30 days. Now, that's a 100% track record with the stats we have, obviously limited stats, and the 18% was the median of the returns. So you're looking at Tesla saying, well, it should go up. Well, theoretically, yes, it would be good for it to go up because that would show you that the elastic demand's there and that people still have a lot of faith, obviously, in Tesla moving forward. So Tesla bulls will be looking for rotation into the stock, and we'll go through the charts a little bit later on. In terms of the options day, it was pretty flat. I wouldn't say there was too much to go on in terms of easy zero DTE stuff. But we did have, of course, that 4,900 breach still. And you can see here that calls are just stacking all over the place, which is really showing you how, I guess you would say, aggressive this area is for markets. Now, 49.50 and 5K are the obvious targets for the S&P. And while it did pull back, you'll notice that the rest of the market of the S&P, things like energy and financials, held it up pretty well, coming down to a 4,900-ish zone. And we'll discuss the key level, which I think the bulls will want to be looking at from the day trading perspective. Now that we've had Microsoft, AMD, Alphabet, and Starbucks missing, yet look at the stock, it went up after hours. We have seen a lot of selling the rumor, buying the fact on Starbucks, and possibly buying the rumor and selling the fact on Microsoft, AMD, and Google. In particular, Microsoft dropping the least because it did have a pretty good report, in my opinion. And it's had a good run up too at the same time. Now all eyes really are on, of course, Apple and Amazon. With in between, we've got the Wednesday FOMC and the statement. Obviously, the conference is really where you get that huge volatility generally. And then we've got non-farm payrolls. It really doesn't get bigger than this. This is super weak when it comes to overall massive news, overall new trend startings, all of those types of things. And the market seems to have got it pretty right in terms of overall expected volatility. AMD came in at about -6, I think, on the session in terms of after hours. Starbucks is doing pretty much what it said, about 4% up, I think. And Google and Microsoft kind of showing a little bit less on Microsoft, but Google coming in around that 5 to 6% volatility. So get ready for a big event because Meta is 7. According to the options market, Amazon is 6 and Apple is 3.5. So we've got some big moves coming up, and it's just going to get more volatile as we go through the week and we see more and more price action algorithms kind of trying to figure out which way is going to be the forward horizon. And especially if we breach under some big levels, we could see a bit of a flash sell that could come through. Let's talk about big dark pool activity. Fairly large one here on ProShares Ultra S&P 500. Just another kind of largest transaction near the high here. And we already reported this one, which of course was the Crane Shares China ETF. Now it's down a little bit at this stage. It's about here. But we did see this level purchased. I can only assume it's a purchase because it seems like the light kind of buy the dip sub of positioning zone. So that's, again, an interesting level, and we'd like to see price move back above that. And we've already been reporting on treasuries, which obviously breached to a new high here, showing that maybe the economy is looking a bit sick and therefore 20-year in particular has been dropping off. We'll check that out soon. We also see here that there's been a definitely large trade going through on a 3x